Hi, welcome to Let's Talk Bonds, the INR bonds. And in this Let's Talk Bonds podcast, I'm delighted to invest Parag Kasliwal, the founder of BeyondIRR, the co-founder, if I may say so. And uh, uh, we, in terms of what Let's Talk Bonds podcast is doing, we are inviting very strong people from the fixed income markets across various segments, largely to enable advisors and investors to understand what's happening across the market space and what's the activity of each segment and where are all the risks and opportunities that are coming through. So in this podcast, we have titled it Opportunities and Risks in Bond Markets. And Parag is the right person to talk about it because he's Beyond IRR is a tech platform that enables the whole wealth management and financial advisory community to select and provide the best products for their clients. Parag has done a fantastic job in building a platform where every product that is available for investments has been researched thoroughly and given to advisors and the wealth managers on a platform on the platform where they can easily actually select what they need to show, give it to their clients, along with the who they based on their own risk profile score. Welcome, Parag, and thanks for joining Let's Talk Bonds podcast.
Thank you so much, Arjun. It's a great pleasure to be with you on this podcast. Thank you so much for having me here.
Thanks. And yeah, so just so many things are happening in the bond markets, like we had in the last conversation on Let's Talk Bonds. Now, there are some very positive things, and there are some other things that are showing a lot of risk as well. Now, let me talk about the risk first. Obviously, US Treasury yields are rising sharply. Global inflation is not looking to come down. There is uh, prices are going up in terms of oil prices and others. In India, there is uh, uh, the spillover of global bond effects on the yields. Short end yields are higher than long end yields and looking to stay there for a long time. The yield curve itself is up in terms of a technical parlance. Basically, rates are higher, right? But in all this, you have very strong equity markets. Economies are doing very well. Job growth in the US is uh, very, very strong and sturdy. India's economy is doing very well. Latest current account deficit also came in very good for the first quarter of this year, showing a lower current account deficit. So showing that the pressure on the rupee is not so high. The currency markets are all over the place. And all this put together, the obviously these are risks. We don't know what kind of spillovers or the after effects of all this can happen. But on the positive side, we have stable yields. Though the yield curve has risen, they have not really risen. GSEC yields have been in a trending. 10-year GSEC yields have been trending in a 7.1 to 7.5%. So not very large movements in the last 1 year. The short end yields are higher, but they are staying there. RBI is not keeping rates steady at higher levels, staying very watchful of the market. And more importantly, economy is growing, borrowing is happening, government is going through borrowing programs easily. Corporates are able to access the bond markets at the levels they want to borrow. And then the latest news of India being included in the JP Morgan index, global bond index. Now, all that is a very positive news. We had covered this in the last search for yield segment. Uh, so, given all this, you have opportunities where if macro stabilize, then interest rates can come down. That's an opportunity. You have the risk where there could be a lot of global effects that can happen to India. And in India too, there could be a couple of risks that can uh, come about on its own especially if the government is spending more and other things like that, or inflation is not able to be kept under control. Parag, in all this, so what do you think is the mood in the community that you're dealing with in terms of fixed income, especially given that a lot of changes have taken place, uh, taxation laws, then advent of bond platforms, more products that are coming through for investors, etc. So, given this, just to get a sense of, you know, uh, what the whole community is feeling in terms of what the fixed income markets are offering for them.
Sure. Thanks, Arjun. Thanks a lot for setting the context as well, and uh, giving an update on what's happening from a fixed income market perspective. Yes, we all are of the same view that interest rates have been in the range bound as far as India 10-year GSEC is concerned, from 7.1 to 7.5 levels. Having said that, in terms of your question as to what are wealth managers thinking and how is the sentiment in the wealth community, and what are they informing or updating their investors about. So I'll divide it into a couple of parts. I'll first talk about what are they thinking about fixed income from an opportunity perspective, and then how they are trying to capture the opportunity is what I will cover in the second part. Now, obviously, when you look at any client's portfolio, wealth management industry focuses upon achieving the right asset allocation for the investors that they're dealing with. And they look at tactical adjustment on a monthly or a quarterly basis, depending on how they think about the markets, right? Now, as of now, when we look at these two larger and bigger asset classes, which is equity and debt, these two asset classes are compared very frequently as to, it is a time to invest into equity, or is it a time to put money into debt markets. From that perspective, as you said rightly, that equity markets have seen one-way rally in the last 6-7 months, and that has given little bit of profit booking or staying away kind of a sentiment in the wealth industry over the last, that has come up over the last 3-4 weeks, specifically given the run up which has happened in mid and small. So people are little bit shying away from making large investments into equities. And that's why there is a lot of discussion which is happening on what to do, where to park money, for the time being. So that's where the fixed income is coming into picture. From what wealth management community is thinking, that as far as India is concerned, and to some extent even global economies, interest rates are more or less at their peaks. Specifically in India, people are very, very comfortable that, further rate hikes we may not see from here on. In fact, we may see the rate cuts starting sometime in 2024 if RBI is able to reach its inflation targeting kind of a range, and then they can start looking at how to further accelerate the growth in the economy by reducing rates. Even today, even given that we are comfortable with the inflation that we are currently dealing with, and the economy growth is quite well as far as India is concerned, people are willing to take bets on credit as well, because they do not see credit cycles playing out and deteriorating very soon. So hence they are comfortable taking credit risk as of now, at least for 1.5, 2 years period. And what is happening is that because of it, over the last 3, 4, 5 months, we have seen lots and lots of wealth houses are coming up with ideas on credit funds, right? Which are typically not offered by mutual funds nowadays, because of whatever happened in the history wherein credit didn't do well with some of the fund houses, and hence mutual funds are shying away from that. But that has given opportunity to PMSs and AIFs, which is specialized fund managers, look at credit as a segment and offer that to these HNIs and ultra HNI clients who are serviced by wealth managers. So another reason for credit funds to see large traction coming in is the change in taxation which happened in this year's budget, wherein finance minister had put all type of debt products on one single lens, which is everyone is being taxed from an interest income perspective at maximum marginal rate. Now, whether it is bank FD or a mutual fund or a straight bond where you're getting interest income, all of these are being taxed at same maximum marginal rate. While yes, long-term capital gain on bonds is still there are benefits of 10% taxation. That's where direct bonds are also seeing flavor from HNI and ultra HNI. But otherwise, given that taxation is almost same for different tax type of instruments, people are looking at achieving the same level of post-tax income, and that is forcing them or making them go for higher yielding bond, given that people are saying that given the current market condition, one can really take a bet on even the higher credit papers. So that's what is there from a
Yeah.
sentiment perspective as far as the wealth industry viewpoint is concerned at a generic level. Obviously, every wealth house has a different viewpoint at different times. Generically, this is what the I would say industry is thinking as of now. Any questions on this, Arjun, before I go to as to how they are deploying the money in various instruments?
Yes, actually, thanks for the full coverage. I will just come back to the second point. But what I would like to highlight here is when I look at risk, right?
Yeah.
And in bond markets, I would say risk is very low. And you may want to, if you compare to equities, you can, I mean, I wouldn't go into valuations and many other things. But if some people feel that equity valuations are high, but if they want to really talk about valuations in the bond space, valuations are definitely low. And I'll tell you the reason why. One is that we are very high in, so maybe it's further from here, but may not rise as fast as what it was when it rose from, for example, in the global economies from 0% to 5%, right? Even in India, 10-year was at 6%, are kept low, and then rose up to over 7% and went up to 7.5%. Repo rates are high in India. It's gone up by almost 275 basis points. Globally, too, it's gone up very sharply. So, if you really look at it, when somebody is investing in a fixed income markets, they are investing at the levels where they can be comfortable with, as in they know that surprises cannot happen. Now, the same thing 2 years back, markets are, as far as bonds goes. In fact, we were telling uh, anybody coming onto the platform that interest rates are, the markets are very risky, uh, and especially government bonds are risky at that point of time, uh, both domestically and globally. And they were actually, they provided the most riskiest of assets. And it played out true. And the second is that uh, when it comes to um, taxation, okay, so mutual funds, because of the um, tax advantage they had, they were receiving a lot of flows into the funds that were offering tax efficiency. And normally what we see is that when there is a tax arbitrage available, then you have a deterioration of risk perception. It happened to MLDs before the tax arbitrage was cut. It happened to mutual funds before the taxation laws changed. Now, when we see where corporate bond issuers are tapping the market at, apart from the PSU and a few very highly rated credits, they have to pay the price a market person is willing to take for the risk One is interest rate risk, one is credit risk, and one is and liquidity risk. So all three risks are getting factored. And like you said, there is so much of interest in credit funds. Now we are seeing clearly AIFs that are offering 15 to 20% private credit investments, uh, where they invest in bonds of private issuers. Uh, they they do their due diligence, and they really build a portfolio which is high risk, and people know that it's a high risk portfolio, and but the returns are commensurate to that high risk, and so people walk into the funds with their eyes wide open. No one's closing their eyes and saying, this this fund is offering so much of returns. I walk into it, nothing is going to happen. So they know, they understand the risks, and they are investing accordingly. Similar with bonds, investors who where they are guided by their good financial advisors are able to find good investments across the credit and the return scale, credit and the return scale, from 9% to 12 to 13% bonds. They are able to invest in across durations, etc. And again, when it comes to the return and the risk that they are taking, they are able to gauge the risk. There is no tax arbitrage available. You are at the peak of the interest rate cycle or close to peaks. Liquidity is not easy to come by, and issuers are still doing well, growing, but they're paying the price for tapping the market. And investors are protected by the fact that there is nothing artificial in the market at this point of time. So that's one thing I would like to state before you go to the second point.
Sure. Thanks a lot, Arjun. Obviously, completely agree with you as far as importance of understanding risk in all these credit AIF is concerned. One should not go overboard in terms of allocating these products. One should understand the risk which these products bring on the portfolio, but accordingly accordingly do the allocations. And absolutely, again, concurring with you on the interest rates that we are almost at peak. There is a lot of opportunity which will come in future if we are able to hold any bond or any product on the fixed income side. Good opportunity to make capital gains, because from here on there is high likelihood that over a medium term period we will start seeing capital gains coming in because of the reduction in rates. And specifically given that a lot of money will start flowing into Indian bonds also, with one of the things that you also captured in your summary of what's happening in the market, which is with respect to inclusion of India bonds in JPM, Emerging Market Bond Index, and as a result of which people are expecting around $15 to $20 billion to come between June next year to March 2025. Yeah, so that will again bring in a lot of demand and ultimately result into reduction in yields because of the demand.
Right.
Sure. Coming to now, what wealth managers suggest typically for different requirements of investors on the fixed income side. I'll probably try and divide it from a duration perspective, which is duration in the sense short-term parking to 1 to 3 years holding or 3 to 5 years holding, and quickly cover that as to what are the typical products which are suggested to HNIs and ultra HNI clients. So from a short-term parking perspective, obviously it's an area where no one wants to take any risk from a liquidity requirement perspective. So the typical products that are invested are overnight liquid, arbitrage funds, everything going into mutual funds there most of the times. If it's related to a business, then it goes to fixed deposits for the short-term period. As well, if it is 1 to 3 year kind of a holding horizon, then yes, a lot of new as well as traditional product categories come into play, which is direct investments into bonds, which is the new trend which we are seeing from this year onwards, wherein a lot of HNIs, ultra HNI clients are now putting money in double A, single A type of bonds. GSEC, SDL investments are preferred if it is a long duration kind of a thing, because what we are seeing again is we are near the peak, and you can, if you are holding long duration bonds, then you can take advantage of capital gains once the starts softening from here on. So that's where the 1 to 3 year holding horizon is coming into play. But as wealth managers, we do tell clients that if your holding horizon is up to 3 years only, don't go for lower rated bonds, because we don't know when the cycle will turn, and you may not be able to exit if it is a lower rated bond, because the liquidity in lower rated bond suddenly dries up if economy cycle turns or credit cycle turns. And that's why for this medium term investment horizon, it is always good to uh, think twice before investing in lower rated bonds. But if the holding horizon is 1 to 3 years, then as the conditions today prevail, probably people are comfortable putting in even single A, triple B type of papers. When the holding horizon is beyond 3 years, yes, people are looking at double A bonds largely, and making investments through GSEC exposure, either through the fund format or directly. So that's what is happening as far as investment uh, instruments are concerned, which are preferred by the wealth industry and the investors, advised by wealth industry. Uh,
Fair
Now,
enough.
yeah, now, yeah,
Just to keep investors and advisors informed,
yeah,
bond platforms like INR bonds are we we show right from corporate bonds to GSECs to SDLs to treasury bills for your investments, and across like Parag was saying here. So if you want to build a fixed income portfolio, and you think that you need to diversify and also capture the most opportunities available, so you can easily build a portfolio where the short end of that is about 1 to 3 or 5 year bonds in corporate bonds, giving a higher return, yield and return. This could be anywhere between 9 to 12%. Or, and for the longer durations, to capture interest rate movements down, purely on that, you can invest in long-term either PSU bonds or long-term GSECs or SDLs as well, which it's a pure play in terms of interest rate cycles coming down. And one aspect on the short end, where Parag was mentioning that people are parking the money for liquidity. There are options available, given that most of the products that at the short end is there's a lot of angst there, because if it's parked for longer period of time, the returns are very, very poor, and post-tax returns can be just about 2 to 3%. And so there are CP products of CPs that are there. Bond platforms at this point of time cannot list CPs. There are short-term bonds that are issued, say 3 year bonds, but that come up, but then have gone 2 years down. So 1 year bonds and or 6 months bonds. These are providing good rates as well. So a lot of opportunities always keep coming up. Investors and especially advisors should be watchful of what's available, which can help the clients get better returns and alpha across their instruments. And we have seen time and again, I think Parag will agree on this, while many investors look at initially parking funds for 3 months, they end up parking it for 1 year or 2 years also. Am I right, Parag? And am I right in
absolutely,
saying that in terms
absolutely,
of
absolutely. Absolutely. Most of these things happen when someone is either trying to buy a property, or someone is trying to start or put investments into business, where they think that investment are about to, liquidity would be needed in short term period, but sometimes many of these events don't happen, and then the money sticks around in these low paying low yielding products. So it is important that from initial period itself, one should evaluate that if there is any chance of putting in of the period becoming longer, they should evaluate and accordingly allocate after looking at the probability of that event getting postponed.
Yeah. And I've seen your platform, and you are definitely making advisors think in terms of providing solutions for clients, because it's just not taking the best, easiest option available, because that easiest option may not be the best for investors. Mostly, it will not be the best for investors. And hence, you're showing all the products that are available on your platform, and also telling them what are the risks and of these products, and how much of allocation should be done. And that's a very strong service that you're providing on the platform to the community.
Sure. Thanks, Arjun. And in fact, I also must highlight the kind of uh, things which are happening. As you mentioned, that there are a number of platforms which have come up, but I would like to highlight one very, very interesting thing that we found in INR bonds as compared to other platforms which are available in the markets on fixed income or bond side, is that INR bonds has great capabilities on understanding the risk on the market as well as on individual bonds, which can be of great help for anyone who's using and coming on the platform to see, uh, what are the right things to do, given, given the current market conditions, given the balance sheet strength of the issuer, etc., etc. So all those insights which are provided by INR bonds, we personally and as Beyond IRR, we find them really, really powerful enough for even our purposes.
Thanks, Parag, and that's very kind words. INR bonds itself, while technology is a very strong point of INR bonds, providing APIs to platforms like Beyond IRR to enable their clients to access the bond market seamlessly and efficiently. We coming up with a good domain expertise. We are able to understand and help give them decision-making tools so that it supports their investment decisions. And with platforms like Parag also showcasing what kind of risks that are available, that are there in each investments, and how to best provide the best solutions for the investors, then it's a very strong feature as we see it. And that's the way we look at it. So you have opportunities across bond markets, and the risks too are there. But risks have to be evaluated but the main, I would say, I don't know if I think Parag would agree with me. I would say the main function of a wealth manager is first understand the risk, and then offer the best returns available to that risk, rather than offering the simplest solution where technically there is no risk, but it can be the most risky at this point of time. Would that be right, Parag?
Yes, absolutely. Given that, as we say in equity market, that being in market and investing in equity, you are taking risk, but that is not one of the biggest risks that you are taking. The biggest risk is staying out of the market, which is very simple thing to do. That, what markets are looking risky, let's stay out of the market. So that's a very simple
Yeah.
decision to make. But because it is so very difficult to time the market, that's the biggest risk that you are taking, because you don't know when the market can suddenly go up and you may completely lose the entire rally. So similarly on the bond side also, simplicity doesn't lead to the best risk reward as far as debt markets are concerned. It is important that we, as Arjun said, we understand the risk profile of the client and accordingly suggest products which are suitable and provide the best possible risk reward for the client's comfort area on the risk side.
Yes, absolutely. And yeah, so we come to the end. We had a long discussions actually, and I think it's been very, very helpful. for both INR bonds in terms of understanding what the community is looking to invest in, so we can showcase products accordingly to suit their needs. Obviously, whatever is allowed regulatorily, and obviously the offering the best possible transaction solutions in terms of buying and selling of bonds on the platform. And hopefully for Parag's platform and community itself, the kind of opportunities and risks that we see in the market, and maybe it could help them in taking the right investment decisions for their clients.
Sure. Thank you so much, Arjun. And we hope to take advantage of the capabilities that you have built on INR bonds on the both tech as well as domain to benefit out of those capabilities. And I am sure the entire investor base that you service will continue to benefit with the capabilities at INR bonds.
Thanks, Parag. And as for your venture Beyond IRR, it's a very unique venture. And from what I can see, it's a very high quality platform, which is offering the best for the community to offer their clients, and providing a much needed service that is required for the community. Thanks once again,
Sure.
and hope to see you on the podcast more often.
Sure. Thank you so much. Thanks, everyone. Thanks for listening to us.